Ladies and gentlemen, good day and welcome to Godrej Properties Q1 FY27 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Kshitij Jain from Investor Relations. Thank you, and over to you, sir.
Thank you, Sagar. Good afternoon, everyone, and thank you for joining us on Godrej Properties Q1 FY27 results conference call. We have with us Mr. Pirojsha Godrej, Executive Chairperson, Mr. Gaurav Pandey, Managing Director and CEO, and Mr. Rajendra Khetawat, CFO of the company. Before we begin this call, I would like to point out that some statements made in today's call may be forward-looking in nature. The forward-looking statements are based on expectations and may involve risks. The outcome may differ materially from those suggested by such statements, and a disclaimer to this effect has been included in the results presentation. I would now like to invite Mr. Pirojsha Godrej to make his opening remarks. Over to you, Pirojsha.
Good afternoon, everyone. Thank you for joining us for Godrej Properties first quarter financial year 27 conference call. I'll begin by discussing the highlights of the quarter, and we then look forward to taking your questions and suggestions. GPL achieved a booking value of rupees 8,651 crore, a year-on-year growth of 22% from the sale of 3,738 homes with a total area of 6.2 million square feet. This is the sixth consecutive quarter in which GPL has exceeded rupees 7,000 crore of booking value. Booking value in the first quarter was driven by strong demand in several new project launches, including Godrej Vanantara, which had 3,237 crore of sales, Godrej Samaris in Gurugram, which had 1,248 crore of sales, and Godrej Brooklyn Avenue in Hyderabad, which was launched right at the end of June and sold 300 odd crore in June, and has sold a similar amount since then. Incidentally, Godrej Vanantara is the third project in Bengaluru to achieve a booking value of more than rupees 3,000 crore in the last 3 years. Bookings contributions were led by Bengaluru at 44%, followed by MMR at 21%, NCR at 18%, and Pune and Hyderabad at 11% and 5% respectively. GPL has thereby achieved 22% of its annual guidance for booking value for the financial year. Collections in the first quarter stood at rupees 4,348 crore, year-on-year growth of 18%. Operating cash flow in the first quarter stood at rupees 399 crore, a decline of 58%. Direct construction spend increased by 41% year-on-year in quarter one. While OCF in Q1 was very weak, we expect our operating cash flow to meaningfully increase in the rest of the year and grow to approximately rupees 9,000 crore for the full year. GPL added 3 new projects with an estimated saleable area of approximately 8 million square feet and expected booking value of rupees 9,500 crore. With this, we achieved 48% of annual guidance for business development in the first quarter. For the first quarter, the total income declined by 16% to rupees 1,337 crore, EBITDA declined by 40% to rupees 545 crore, and net profit declined by 42% to rupees 350 crore. This was because we had only one project completion in Q1, and that was of a DM structure project. We remain on track for 13.5 million square feet of deliveries in the full year and for achieving 20% ROE in financial year 28. With a robust launch pipeline and strong balance sheet, we are confident of delivering another strong year. On that note, I conclude my remarks. Thank you all for joining us on the call. We'd now be happy to discuss any questions, comments, or suggestions you may have.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and then 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Your first question comes from Puneet with HSBC. Please go ahead.
Yeah, thank you so much, and congrats on good sales bookings here. My first question is with respect to, your view on the various markets that you operate in. Which markets do you feel more excited about? Where are you a bit worried? And how are you thinking about business development in those areas?
Thanks for the question. One of the interesting things we've seen from a data perspective at an aggregate level, right? That the first 6 months H1 performance for overall Indian residential real estate has been very strong. I think the only laggard in the game, from a quarter one perspective, pan-India would be give or take Gurgaon, which also I think quarter two would see a good uptake because the supply has not hit in Gurgaon as much in quarter one than we expect in quarter two. But you'll be surprised that in many markets, the absorption has increased between 10% to 25% levels. This is quite a strong aberration. So I think overall market seems to be quite strong. From a relative perspective, I would say Bangalore and Hyderabad and Noida clearly doing exceedingly well as markets. I think Bombay, it is, I would say, core Bombay, which is western suburbs, micro markets of South Bombay, and Thane are doing very strong. These are, I would say, highly attractive markets, but early days, even Pune is looking slightly better than what it was, say, in the last 2 odd years. So I would say, when we were entering the year, I was thinking that we would be an outlier. There could be a very different market, but the year has started at a very strong note for the market in general and of course for us.
Understood. And on the cost side, have you been feeling any impact of cost increases, availability of labor, etc., given that you've now scaled up massively and there has been some chatter about minimum wages going up, etc.?
Yeah, there's a 2.6% minimum wage or so, some markets that have hit, but broadly nothing that was not planned for, because wage rate inflation is a very predictable event, and when you buy land, especially in the model that we have, we do model the typical wage rate inflation. But I think the entire Middle East crisis did have an impact. If you remember, we even discussed this point in the previous earnings call. I would say we were seeing a slightly strange scenario, a very secular strange scenario till about May end. From June and now, I would say there is some amount of change happening, still early. Yes, relative to say a position of February, there is a cost inflation, but there are some very encouraging signs. Like the steel cost has give or take reduced by almost 12% in between, say, to even a February cost base. Even items like lift systems have seen a marginal cost drop, but things like aluminium have shot up. Tile availability was a huge challenge between April and May, and marble availability. That supply side issue has got resolved, but there's some amount of price drop also we've seen both in marbles and tiles, but relative to February still inflated. So I would say as and when we would see in the coming months supply side getting more and more recognizing the supply side constraint getting over, I would say the cost drops will happen. But I mean, nothing really worrisome. I would say about May, if you ask me the same question, I would have been more worried on the trend, but now the trends have started reversing.
Understood. And you have a significant amount of projects ready to get completed in FY28. What percentage of inventory would still be unsold for those projects?
I wouldn't know the aggregate number offhand, but if you just see the
Broad
specific
number.
talks about the 16 projects, we have added a specific slide. The 40,000 crore booking value that we said is more or less is basically already sold out. It's not that we have a huge inventory, because most of these are stellar projects like Aristocrat. 98% is sold out. Reserve, we sold more than 6,000 crores of inventory. So MSR City.
The next show of our presentation actually has all the details by project.
Yeah.
Understood. That's great. That's all from my side. Thank you so much and all the best.
Thank you.
Thank you.
Thank you. Your next question comes from the line of Gaurav Khandelwal with JP Morgan. Please go ahead.
Hi, good evening. Thanks for taking my questions. My first question is on business development. So we've done close to 9,500-10,000 crores in first quarter itself, and I'm assuming a lot of this would have been known by the time we had given FY27 guidance of 20,000 crores. So what's the Do you think this year would again be one of those years where we meaningfully overshoot the BD development guidance? And what is the kind of pipeline that we are looking for, at least in the next 1 to 2 quarters, where you would have a more better visibility? That's my first question. I'll have one more follow-up after this. Thank you.
Sure. On business development, actually, no, we didn't have any idea about these when when we were issuing the guidance. Actually, the big contributor to this 9,500 was a 7,000 crore land in Noida, which we won in auction subsequent to that. So I think that was again the main contributor. I think we've said that, on business development guidance, we've intentionally put out a fairly conservative number because we don't want to have any pressure or requirement to do business development just to meet any guidance. We've also said that, I think thinking about business development as more of a replacement to sales is probably roughly where we think a healthy level of business development would be. Our sales for this year guidance is, of course, a lot higher than business development. So I think somewhere in that range is where we would expect to end, and Q1 is therefore quite in line with that.
Got it. But just to understand this better, in that context, what are the key risks outside of business development to the FY28 positive FCF that you mentioned in this quarter's presentation?
I think that is, I think that is the key risk, if you want to call it that. I'd say obviously we think we're only putting in capital when projects are going to generate higher than 20% IRR. So generally we feel adding new projects is very positive because they're meeting our rigorous kind of thresholds. But that to me would be the big risk if we did overshoot that. But I think we're quite clear also both in terms of what stakeholders would like us to do, and we think that the operating cash flow will be strong enough to ensure very robust business development plus from free cash flows next year. I think the only other risk is very substantial project delays or very huge kind of cost overruns because of this global situation worsening or things like that. But those would be, I'd say, relatively small risks in our view.
Thanks. That's very clear. My second question is, how are you looking at the activities of NRI customers coming back to the market? Have they come back to what the quantum of business activity with them was prior to the Middle East war, or do you still think these are still early days?
First of all, we have not modeled historically our sales on NRI per se. Give or take, we have like a 10% sort of NRI sales. So we were fairly insulated. Doesn't create either a major upside risk or a downside risk for us. That being said, I would say there is a structural shift we are seeing within NRI market, more specifically in the Middle East side. I would say previous to the crisis, right, India was more of an opportunity for NRI customers to look at an investment base for India. And, give or take, their horizon of investment, say 2 years, 3 years, 4 years, was a typical way of them looking India. And I'm talking about the bulk of the community. I think that is fundamentally getting changed. It's still very early because a lot of people are now looking that, maybe Middle East is not the safest place anymore. So should they look back moving to India? What should they do outside? And those conversations have happened. And I think the closest parallel, and I would say it's very premature to say that, but something like COVID, right? That the triggers to demand after COVID was largely psychological, and that totally shifted the demand patterns for the core property market. I think this is an interesting situation to sort of draw a parallel and study that. I think it's very early, but yeah, the quality of conversations have really shifted from the Middle East market. Barring Middle East market, I think it's pretty much business as usual. A lot of people are looking India as a good place to invest purely from a long-term currency hedge, and people want to buy properties for their parents or come here back for retirement. So that kind of is more or less similar.
Got it. Thank you. And if I just can ask one more question. In terms of the KPI for top management, what are the top 2, top 3 things which have the highest weight on the scorecards? Is it market cap? Is it free cash generation? Is it ROE? Just to get some sense.
Yeah, sure. We have 4 key metrics that we use for incentives for the team. The first of those is cash collection. So that is, we've purposely chosen collections instead of operating cash flow because we think collection encourages overall speed of delivery, which is good for customers, good for long-term health, whereas OCF can also sometimes in the short term be achieved by cutting down on construction costs in parts that are not increasing immediate collection. So we think collections is a better cash metric, so that's the one we've used. We also have imputed profits, which incentivizes both bookings growth for the company as well as margin creation and margin enhancement. That imputed profit is multiplied by what we call an asset management factor, which either rewards or penalizes the teams based on enhancement or reduction in existing locked-in profits. So that's the second bucket. The third is reported profits, where, honestly, I think it was more to bring in the discipline and focus on this mattering over the long term. I think there's not very much teams can do other than, plotted developments, etc., to move and faster delivery to move in year profits, but we think helpful in creating that trajectory. And the fourth is a net promoter score where we measure customers' ratings of directly from our customers' ratings of their experience with us, and that's of course to incentivize quality customer service and long-term brand enhancement.
Got it. Thanks. That's very helpful. And is there any discussions of switching to a percentage completion accounting from the PCM one currently?
Sorry,
Shifting to percentage completion.
No, we think it will be very complicated. Our view is that in certain jurisdictions like Haryana and Karnataka, the RERA rules don't support the use of percentage completion accounting. Maharashtra, of course, it is easier to do that. So no, given our national business, we feel that we'd either probably have to maintain different types of accounting standards in different geographies, which we think would just add to the confusion. We of course, over the last couple of years, have introduced imputed profits and are publishing those on an annual basis to help signal to markets what operating numbers look like. Those are, more in the direction of percentage completion versus project completion. So hopefully, investors can get a decent sense of where things are based on one, operating cash flows, two, imputed profits, and hopefully, as some of the newer projects finally start reaching revenue recognition towards the end of this year and largely next year, we'll also get a sense of reported profits. So no plans to switch the accounting.
Perfect. Thank you very much. Those were all my questions.
Thank you.
Thank you. The next question comes from the line of Abhinav Sinha with Jefferies. Please.
Hi. So first question on the construction outflow, which has scaled up now to around 2250 odd crores. Where do you see this settling by the end of the year?
Thanks, Abhinav. Difficult to exactly comment on the exact number, but if you look at, I don't think we've published this number, but give or take the percentage that you saw last year, we will try and mimic something closer to that. I would say between 30 and 40% is the ideal range to almost ensure that next year PAT is certain. But of course, in projects, certain projects, the outflow will be more on core and shell. Certain projects could be more in finishing, and they both have very different outflow streams, right? But I think fair to say every quarter you'll see a base effect between 20 to 40% range of quarter-on-quarter, year-on-year sort of a growth. And that's what we ideally would aspire to do, all things remaining same. I think the NGT could be a period where, depending on how much the ban period is a sort of unpredictable COC line item for the year. But that aside, I'm very confident that we'll see a very good spike on COC and also operating cash by the end of the year.
Okay, sir. Got a second question on sales. So you, pre-sales basically, so you have earlier said that you would like to have smoother sales across the quarter. Now looking at the launch pipeline, how do you think this year is going?
I think we started at a very good note. To be very frank, quarter one is usually the slowest for us, purely because teams go above and beyond in quarter four, and people, as you know, that children have holidays, so people travel a lot. So, and approvals also, everybody tries to push as much for launches in the quarter four. But I think this year what we did fundamentally different in quarter one was to focus on sustenance fairly well. And if you see, while the quarter overall number is quite exciting, especially from peer group point of view, 41% or so came from sustenance sales. So I think we have a good launch pipeline throughout the year. The big ones which are immediately coming are like the Bandra launch, which we've seen what Worli has done to our portfolio and to the city. I have very high expectations from Bandra, and similarly, Golf Extension Road is a huge launch which will come in Gurgaon, and then there are a couple of launches in Bangalore, and Hyderabad, and Pune. But to be very frank, sometimes it's extremely difficult to predict launch exact timeline. So the controllables therefore becomes there are some thresholds of timelines we define internally for RERA approvals, and so there is a launch activation model that we follow. But if those tend to get breached because of approval delays, we start shifting our focus more towards sustenance. So there will be a degree of predictability on quarter performance. But yeah, I mean, there could be some quarters which, because of lumpy launches, could see an exponential jump, but there would be a minimum threshold we would like to maintain quarter, something like we've done for the last maybe 6 quarters. We've delivered always 7,000 crore sort of a number. That's sort of almost like an internal bare minimum we always have, and endeavor is 8,000, 9,000, 10,000 sort of trajectory, and then taking with launches maybe even further. So that's the broad. I don't want to commit to a number per se right now, but I mean that's the thought process we model ourselves when we look at a quarter.
Great. So one last question. So on, I mean, you've given a FCF positive guidance and put some numbers also for FY28. How do you think FY27 we should see net debt, moving in the next 3 odd quarters? Thank you.
Yeah, I think, it could be a little bit up and down depending on, how much BD happens and what's the exact collections quarter by quarter. I would say roughly to get to the 24,000 crore collections and 9,000 crore OCF we've guided for this financial year. I think, there'll be a build-up through the year, and Q4 will probably be the strongest of the 4 quarters. So you'll see Q2, I think, significantly better than Q1. Q3 should be better than Q2, and then Q4 should be quite strong. I think, there's a decent chance, even in the rest of FY27, we will be free cash flow positive unless we do a very high level of BD. Because I think that the remaining collections for this year, just in the last 3 quarters, are about equal to our total collections last financial year. So I think there is good opportunities, but I think honestly, the main focus for this year is to make sure we make a lot of construction progress. Some of those collections will of course come this year, but a big portion will also happen next year upon delivery. So I think that's priority number 1. And while we know, the market's very focused on this free cash flow number, and we are too, but we want to balance that with the opportunities we see for growth at the same time. We think on the large base we've established, if we're able to next year report a 20% ROE and also report 20% booking value growth, we do think that will be well appreciated at that stage. We think the market is perhaps a little more focused on efficiency right now than growth, because they have more evidence from us in the last few years of the growth than the efficiency. But we're seeing the internal numbers, we're quite confident and convinced on the efficiency. Therefore, we don't want to overcorrect to respond to the market and kind of not also capture the kind of growth opportunity between us that is present. So we do want to keep these two things in balance. We've already said that we would look at 10,000 crore net debt as a cap that we would not like to exceed, and we'll work to make sure we stay within that. That said, I think there's every chance that even in the next 9 months of FY27, we could be free cash flow positive, and we'll of course, unless we're seeing really exceptional business development opportunities, endeavor to do so. But I think FY28 is the year that we feel, even if we see great BD opportunities, given the scale we're likely to have of operating cash flows, we're very confident that year we will be free cash positive. And I think it, to us, isn't an absolutely critical deliverable to do that this year, so long as we're keeping our net debt broadly in check and we're confident that the BD we're doing will deliver strong growth. And I think, obviously last year was a good BD year for us, and we hope to demonstrate the value of that through, having a great booking performance this year.
Thanks, and all the best to the team.
Thank you.
Thank you. The next question comes from the line of Pritesh Sheth with Axis Capital. Please go ahead.
Yeah, thanks for the opportunity. Just a couple of questions. In terms of launches, maybe if you can just highlight on the GDV, across next 3 quarters, we have balanced launches of 37,000-38,000 crore. We had almost 11,000 crore of launches this quarter. Q2 would be similar or slightly better, and then obviously second half is expected to be quite better, but just trying to understand how should we think about the trajectory of this.
Pritesh, I would say there is the entire launch set of approvals, which just like in quarter one we were running, right? So let's see where exactly which dates we get it. Actually, if you ask me, the big ones seem to be on track. Depending on the day we get the approvals, we'll take a call whether it makes sense to launch and push this within the quarter, or would it make more prudent sense to do it to the next quarter. I think the 2 big ones are Bandra and GCR extension, and they have meaningful impact on absolute performance. But these are both are very high margin projects, so we don't want to necessarily just to compensate for a number, push them either this quarter or we would like to see if the approvals come in the next 15 days, we'll push it within the quarter. If it takes more time, we might take a call to do the next one. But there are some approvals which seem to be on track and have already come, and we are doing good sales in that. You would be happy to note that projects which we got almost towards the end of the last quarter, like there was a project in Hyderabad which did about 300 plus crores, has already crossed 650 odd crores, and this with the cumulative sales by now, Samaris has crossed 1500 crores as we speak. So I think there is some amount of launches of last quarter towards the later part will continue to see growth. So I think we'll take a judgment call somewhere, I would say 3rd or 4th week of August, looking at the approval timeline. But fair to say the overall launch calendar, 15 days here and there aside, is absolutely on track and looks very promising.
Sure, perfect. That's helpful. So 2 bigger ones, Bandra and Golf Course Road, would be either Q2 or Q3, not Q4, is what one should assume.
Q2 or Q3, no Q4. I think it's either within this quarter, maximum.
Okay, fair enough. And second on, firstly, thanks for the free cash flow guidance, cash flow guidance overall, and the free cash flow target. Just one question on that. I mean, obviously there would be some collections cash flows arising out of next year's sales number. Have you still assumed a growth over this year's base, to arrive at those cash flow numbers, or just directionally what are we thinking in terms of how our business is going, and how much sensitivity is there if let's say if on pre-sales we flatten out next year, how much impact it could have on our, that 11,000-12,000 crore OCF that we are probably expecting next year. Yeah.
Yeah, Pritesh, I think this builds in for this year what we've guided, the 39,000 crore bookings, 24,000 crore collections. And yes, there would be some growth assumed in that, but I don't think it's anything extraordinary. And so this is really our CBE. I think that could there be some downside risks if the sales situation in the market very significantly deteriorates, or the construction schedules get very disrupted by global events? Of course, there could be some, but I would say there's as much or more upside risk if markets hold up and we're able to, as Gaurav said, launch things like Bandra, which is a big project for us. Ashok Vihar has also been making some progress in approval. So if some of these launches, there could also hopefully be some upside potential to this. But yes, it is a CBE basis. Our current view of how things will improve. We've made an attempt to neither make it too aspirational nor too pessimistic.
Sure, pretty helpful, and thanks for the disclosures. Thank you. All the best.
Thank you.
Thank you. The next question comes from the line of Girish Chaudhary with Avendus Spark. Please go ahead.
Yeah, hi. Thanks for the opportunity. My first question is again with respect to your guidance on the OCF which is around 8,600 crores for the balance of fiscal 27. And also you guided for collections of roughly around 19,650 crores, right? So the implied gap or let's say the implied outflow is around 11,000 odd crores, right? And then if I look at the Q1 construction and other project outflow was 4,600 crores, right? So the implied 11,000 crores for the rest of 9 months is a sharp lower run rate versus the Q1. So if you could just explain this, how should we look at going ahead in terms of both construction and other project-related outflow?
So the, Girish, the construction spend obviously will improve going forward. So that will also depend on what kind of, projects are going at what stage they are. Okay. So those will vary a little bit, but what we have said that over the entire year, we will be able to generate 9,000 crores of OCF, with a 24,000 crores of collection. Now, between that collection figure and OCF, there are several cost items like, construction spends, other related outflows. There is a brokerage marketing spend, which directly or indirectly dependent on the kind of sales launches, what we do. So those will, keep changing, but what we are confident is that if we are able to deliver that 24,000 crores of collection, we will be in a position to generate that 9,000 crores of OCF.
Got it. If you could help us give a detailed breakdown of this other project-related outflow in terms of some of the key items like JV partner payments or let's say marketing.
I can summarize. I don't have the number of an item, but the other cost includes a lot of statutory taxes like GST, TDS, JV partners outflow. Then the third is advertising and marketing spends, those, and other overhead items. Maybe we can, connect offline. Maybe Kshitij can give you the detailed breakup also if required. So those are the major items which goes into the other other outflows.
Yeah, sure. That will be helpful. And second, specific to the Hyderabad launch, the Brooklyn Avenue, the launch is number is around 2.66 million square feet, but sales we have achieved 260,000 square feet of sales. So if you could just clarify how much of the inventory was actually released for sale, or is it because of the project being launched in the late in the quarter?
I think we launched it almost, very frankly, towards the last week of the month, and the team which is driving this was chasing a glorious number of becoming the highest quarterly number by any zone ever. So they wanted to push, and we were, left it to us. I would have pushed it to Q2. But the interesting thing is we've already crossed. So we did about give or take 300 plus crores in Q1, and by now we've crossed close to 650 crores. And I think in the next few weeks, the endeavor is to hopefully cross between 900 to 1100 crores, some sort of a number. So yeah, just about, the team wanting to push and achieve a sort of a, there's an internal good, healthy competition between different zones. And this was a record that South business wanted to beat, and they actually now have this new record. So these are small, I would say, snippets, but yeah, project is doing fantastic.
Got it. That's helpful, and thank you.
Thank you.
Thank you. The next question comes from the line of Rahul Jain with Elara Capital. Please go ahead.
Hi, sir. Thanks for the opportunity. So last year we saw, you entering a number of new markets, tier two cities, tier 2 markets through plotted development. Are you seeing, should we look at FY27 also that you'll add few more cities to your pipeline or deepen your presence in those markets?
Sure. It is very opportunistic. We have a set of cities which we've defined a set of criteria from per capita income to infrastructure, policy environment, the quality of development profile that the city finds aspirational. So we've done a group of cities, and we have a team which is continuous scouting for opportunities. But to be very frank, this is still a very sub-scale as a business per se for us. It's not going to be more than 10 to 15% of top line. So yeah, we've expanded to many cities by now. We've gone to Nagpur, Indore, Faridabad, Kurukshetra, and many more cities. And we've had stellar success, including sold out projects by now. And yes, we could have a situation that maybe 2 to 3 projects again we could sign up in the next couple of months. But again, there is no desperation to essentially target a city and have to enter, because usually the thumb rule is that you get a booking value of 500 to 700 crores after one acquisition, but a very high PAT margin. So the criteria for us is that if the margin profile is not super attractive, we don't want to actually enter to a tier 2 city. At the moment, there is a good pipeline, and won't be surprised that by the end of the year you'll see 2-3 new cities getting added up, but that's not really something we are aggressively driven towards.
Got it, sir. Very clear. Thank you.
Thank you.
Thank you. Your next question comes from the line of Kunal Lakhan with CLSA. Please go ahead.
Yeah, hi. Thanks for taking my question. Just on the revenue recognition bit that we have forecasted for 27-28, do we have any idea how much of this 40,000 crores would come in 28? I'm just trying to work the math on the 20% ROE would be based on like what revenue base?
Yeah, I think, we've purposely just given it as an indication, and of course, exactly what revenue recognition happens is dependent on the percentage completion. Even some percentage completion will remain after OC on the exact levels of sales. So I think forecasting all of that can be a little bit complicated, but we've tried to now give as much information as we can. If you look at the annexures in our presentation, which have a project by project breakdown of what is sold and so forth. So you should get a generally good sense. What I think we were trying to highlight is because we got questions on what will lead to this 20% ROE. So it's very clearly this set of projects reaching revenue recognition is what's going to very significantly increase both revenues, margins, and therefore reported earnings and ROE. So we just wanted to put out those list of projects to help the market get a better sense of where things stand. And obviously what that shows is that over the last 2 years, FY25 and 26, the booking value of these projects that have reached revenue recognition is about 17,000 crores. That's going up to 40,000 crores, so almost 2.5x just the booking value recognition. But of course, in addition to that, there are other important things to keep in mind, such as that the GPL share of those projects is moving from 70-odd% to close to 90%. And we think these are projects that have been launched in a better part of the cycle, outright ownership, so margins of these should also be higher. So all of that hopefully should indicate why we're reasonably confident on getting to this 20% ROE next year.
Actually, I was just trying to get exactly the same number what you just said, right? I'm trying to get my head around that. What could be the margins on these 40,000 crores? Like, could it be in the upwards of 30% in terms of EBITDA margin, or like in that 25 to 30% range?
Yeah, I think we should assume the same. We've guided to this PAT margin of 15%. Some projects will be above, some might be slightly below, but roughly that should be, I think, the assumption.
But the work completion would be another percentage that will get multiplied. Because I'm assuming you were assuming 15% to 40,000 crore, 6,000 crore in this and next year. But there will be some projects which could be fully completed. There could be some projects 80 and 90% work completion.
Yeah, and of course then there will be some associated overheads and other things that are not.
Understood. And considering like the land prices also have gone up significantly over the last few years, the projects that we are currently underwriting, right? What kind of IRR or margin expectations do we build in?
There's no change. We would hope in good markets to be able to deliver a bit better than those IRRs, and certainly some of these projects that are coming up for delivery will have better than 20% IRRs. But we're maintaining the expectation of 20% IRR, maintaining the expectation of 15% PAT. And as we said, we're in no burning urgency to do business development. We feel we have a very healthy portfolio across markets. So if we're not seeing land values aligned with that, we're happy to slow down temporarily. But recent evidence is we continue to find good opportunities. We're quite happy, for example, with the auction land we purchased in Noida in Q1, where the land value to expected booking value is well under 10%. So they continue to be, we feel, good opportunities.
But say the 22,000 crores of operating cash flow that we're expecting over like next 7 quarters or so, would we focus more on like ramping up the business development, or we'll just kind of try to manage our debt levels in a way?
I think, as I was trying to explain earlier, we want to hold these two things in balance. Look, it's very easy for us to say, let's just slow down business development, not going to hurt sales for the next couple of years, and we can generate strong free cash flows and get to zero debt or, whatever it is. But we're not really seeing how that actually enhances the long-term value of the company, the long-term discounted value of our cash flow. So what we're trying to do is get that balance right. We clearly think there are problems with getting too leveraged and too aggressive on growth, which is why we've always tried to raise capital on the equity side if needed before. Now we're very clear that we want our OCF from next year onwards to fully cover business development. But at the same time, if we're able to do, 39,000 crore sales we've guided for this year and grow that by close to 20% a year, that is also creating a very meaningful value pipeline for the company. So we don't want to get, in our view, carried away with this. We only want to generate cash flow and are very happy to sacrifice growth. It's getting the balance right that will truly create value for the organization. I think going too aggressive on sales and discounting our net debt cap or the importance market is attributing to us getting to free cash flow positive is not a good idea, but nor is slowing down business development entirely, because that is bound to affect future year sales. Even if you do have a reasonable pipeline, we're obviously able now to launch almost every project we're adding within a year. So again, we hope to show this year, given the 42,000 crore business development last year, a very strong sales performance. I think we're quite keen to balance these two. We think that means roughly free cash flow break-even going forward for the rest of this year, and hopefully strongly free cash flow positive next year, while not sacrificing on the investments needed to generate continued strong growth.
Great. Thanks, Parosha. Congrats on the great pre-sales and all the best.
Thanks, Kunal.
Thank you. The next question comes from the line of Akash Gupta from Nomura. Please go ahead.
Hello, am I audible?
Yes, sir, you're audible. Please go ahead.
Yeah. Hi, sir. Congratulations on a fantastic quarter. My first question is again on the 20% ROE number for FY28. I mean, a 20% ROE would essentially imply like a 35 to 40 billion of PAT versus 18 billion in FY26. And similarly, on the revenue side, this would imply like maybe 300 billion of top line versus 50 billion in FY26. This is with respect to the slide 8 I wanted to discuss. So is this a valid assumption?
Well, we certainly think so. We wouldn't have put it in the... sorry, you mean is your assumption valid? I thought you said is the claim valid. Yeah. Well, I think we're sticking to what we've put out. But yes, obviously 20% ROE, our net worth is already about 20,000 crores. So obviously, we have to have 4,000 crore or more of PAT to get there. So that's certainly correct. I think I won't comment for now on your revenue assumptions, etc., because there, of course, we'll see what the margins are. But yes, I think we also, this whole idea of putting out this list of projects was to try to create more confidence in what will get us there. So now, if we deliver these projects, this is our current understanding of where costs stand, what the revenue to be recognized is that we will very much get to this. Now, what are the risks to this, you could ask? Again, largely they would be focused on project deliveries happening on time. A big part of this is slated for the second half of financial year 28. This industry is unfortunately, of course, notorious for delays of various kinds. Another risk is a significant part of this is in NCR, which of course has these NGT bans and other things. But all of that factored in, we're still confident that this will get delivered. And it's, of course, after we've put this in the public domain repeatedly and commented on it, I think we're all extremely motivated to make sure there is no slippage and that it does in fact happen, and we'll leave no stone unturned to ensure it does happen. The other risk, of course, could be on any kind of extreme cost escalation. That to us seems very unlikely, even despite the kind of very difficult global situation there has been over the last quarter. We've not seen things get totally out of whack, as Gaurav was explaining earlier. So there are risks. We do have to execute well, but we feel those risks can be contained, and we're extremely focused on making sure we deliver this number.
Understood. Thank you for that. And my second question is on the launch pipeline for the second quarter. I understand there's one in Gurgaon and possibly Bandra might come, but what other projects are in the advanced stages of approval which may be launched in 2Q?
Quite a few, ranging from projects in Bombay. We have, quite a few inventory left in Panvel, so we would like to add a new launch in Panvel. There is a launch which we anyways have just done in Hyderabad. From our definition, it is going to be a launch, and we are seeing a very strong trajectory in Hyderabad for that. We are pushing one more launch in Bangalore. There is a launch we did in Noida, and there's a few towers we will open up in Noida. A few launches planned up in West East, which is a combination of Pune and even Ahmedabad. So I think we have a bunch of launches across markets, but as I mentioned, apart from Bandra and G3 extension, as I mentioned, that some of it will depend upon the approval progress, and we'll take a view that which of these we would like to do within the quarter, which we would like to move outside this quarter to deliver a bigger number from those specific projects. But I mean, fair to say this quarter is going on the track of the overall trajectory we would want from this quarter.
Understood. And sorry, if I may add just one more question. Just from a payment plans perspective, like what percentage of our new launch, for example, we are offering like payment plans which versus a construction link plan, and how does that impact our cash flows? Just some thoughts on that, please.
Sure. I think you mean to say what industry normally calls PLP, possession linked payment plans. I mean,
Yeah.
We do because that could drive up dead inventory sales of projects which are just either getting OC or about to get OC. So to give you a sense, previous quarter, which is the quarter we're talking about, our Q1 sales on PLP bucket was very low. I think probably, if my memory serves me, 5.1%, of which I would say a bulk of was in two projects which are seeing OC within the next 6 to 12 months. So technically we tag it as PLP, but it's not really PLP. And then there are, say, 3 units there, 2 units here, dead inventory across GPL that we sell. So give or take, not more than 5% is a cumulative sales, and project which is within the year, if I exclude that, maybe 100, 200 crores or maximum 250 odd crores could be projects which are in different stages of construction we would have wanted to liquidate, which is very, very small at our scale. So we are quite obsessed on quality of sales and cost of sales in an industry where cost of sales in our peer group can range from 5% to 10%. Even in Q1, our cost of sales is about 4%, thereabouts.
Understood, sir. That's all the question I had. Thank you so much.
Thank you so much.
Thanks, Akash.
Thank you. Ladies and gentlemen, as there are no further questions, I would now like to hand the conference over to the management for closing comments.
I hope we've been able to answer all your questions. If you have any further questions or would like any additional information, we'd be happy to be of assistance. On behalf of the management, thanks again for taking the time to join us today.
Thank you.
Thank you. On behalf of Godrej Properties, that concludes this conference. Thank you everyone for joining us, and you may now disconnect your lines. Thank you.